A crazy week in 10-year note treasury yields as we saw yields open up on Monday only to plummet down to 112, lowest we've seen since mid-February, and then rebound back higher close to 130, basically ending this week where we ended last week. So basically week over week, not much change, but a big move was seen obviously in between the fears of more lockdowns, the fears that this variant is expanding and how it would affect growth and how it would affect the world's global reopening. Put a little bit of fear into bonds. We saw yields go down. They quickly recovered, but ultimately at the end of the day, we have a lot more, we want to see a lot more proof. We get some events next week. We could change everything as we always do. And at this point, we're going to in sort of a wait and see mode for the bond market. Now, what does that mean for volatility? Well, on that decline we saw on Monday, volatility skyrocketed. Usually volatility goes down when yields go down, but when you start to break through those low thresholds that we're at, there's some concern in there because we're not moving down for good reasons. We're moving down because there's fear in the market, and fear brings out volatility. So we did see volatility bid to start the week. Things came off as the week progressed and yields rose back higher. Now, we're still not back into that old comfort range, we'll call it, between 140 and 160 in the 10-year note. However, we are closer than we were. 130 is closer than 112. And at this point, the worst seems to be past, at least until we get through next week and get through some of these other issues that we'll talk about in a moment. Now, what do we have next week? Well, we've got GDP, which could show growth of 8% in the second quarter. We've got PCE data, which could show a continued rising inflation. Likewise, we also get the University of Michigan numbers, which will have its 1 and 5 year inflation expectations. Both have been on the rise, both expected to continue to run higher. So where does that leave us with the FOMC that we have next Wednesday? Well, the Fed will kind of have to bring it all together. They've continued to stand by their transitory talk about inflation. It's here, but it's not here for permanently. Likewise, they got to be happy with those growth numbers and also with the earnings numbers we're getting out of the equity markets. The other wild card out there is the debt ceiling, which on July 31st will end the 2-year period in which they froze the debt ceiling. Treasury Secretary Yellen out today saying if we don't do something about that, Treasury's going to run out of cash come October. So there needs to be some agreement made, at least if we're going to avoid what happened in 2011, and that's when the U.S. had its AAA rating stripped. So at this point, we don't want that. That could be a ripple effect that could see equities go down, see yields skyrocket. At this point, that's not what anyone wants, especially the Treasury or the Fed. And look for them to come to some agreement. Obviously, it's not going to happen overnight, but they have a little more time left prior to when things can get really ugly. So after a big decline in yields to start the week, we creep back higher. We have a big week next week with growth, inflation, and the Fed and Treasury yields right now hovering at about 130.